The big issue or clamor for the developing world is that meeting these goals is expensive. It's because it's prohibitive for them and even more challenging than the developed world, and that there is a need for a more just and equitable sourcing of financing. What does CDPQ stance on this, and how might you actually bridge this gap where you need more just sources of financing and more equitable sources of financing, but you've got a developed world and groups like CDPQ that might say, hey, I still have to make my returns because I answer the needs of 8 million people. Again, my apologies for complicating the problem even more.
This is a question that we've been, circulating internally, as well as we're founding members of several associations, so including ILN, including SMI, as well as the Net Zero Alliance. So just to name a few. So on that specific topic, developing versus developed world, we think that a potential solution is blended finance. So blended finance means the local government have to step up, the private sector money will have to step up, developmental agencies will have to step up, and then finally a certain segment of the philanthropy. So all of that would have to come in to what we call blended finance, such that because each of us can then look at different parts of the risk reward and take what we can live with, such that in totality it is then potentially possible to finance transition to with a large scale.
Right.
Yeah.
And just very quickly, this is also becoming, again, even more challenging because we are facing a higher interest rate environment. Now, I know that CDPQ, like many groups like yourself, your peers, is a long-term investor, but how has the recent high rate interest environment influenced or perhaps made you tweak your strategies for the time being in response to perhaps this higher cost of funding that we're seeing right now?
Correct. So that's the one thing that, for a pension fund like ourselves, we've always been very, very keen on total asset allocation. So meaning if you look at us, we have debt, we also have equity across all of our asset classes. We have public, we have private, such that we have a more natural concentration, diversification, and so that, if you look at our 10-year return, we've been able to do 8% over 10 years. And that is not surprise because we really all the time are trying to allocate. So this higher interest for longer, it will impact how we invest for equity as well as debt, but overall, we're comfortable with it.